is to take advantage of tax breaks granted to certain financial instruments by government policies. 2 is the process of analyzing one's finances for tax advantages informs your accountants and other tax professionals of potential methods to maximize tax breaks and minimize tax liabilities legally and ethically. In fact, the bottom line is that the more tax breaks that you have, the lower your tax liability will be. And let's face it, who wants to pay more taxes than they have to? I don't think anybody on this webinar. Quote from Supreme Court Justice from 1916 to 1939, Louis D. Brandeis, encouraged taxpayers to take advantage of other tax benefits. And his quote goes as follows. I live in Alexandria, Virginia, he said. Near the Supreme Court chamber is a toll bridge across the Potomac. However, I usually drive outside the downtown section of the city and cross the Potomac on a free bridge. If I went over the toll bridge and went through the barrier without paying the toll, I would be committing tax evasion. If, however, I drive the extra mile and drive outside of the city of Washington, I'm using a legitimate, logical, and suitable method of tax avoidance. And I'm performing a useful social service by doing so. So I like to think of the useful social service as he's letting you know that taxes can be avoided legally and ethically if you do it the right way. So in fact, we always talk about it, Rachel. In Philadelphia, they have now a juice tax, right? And by the way, it's my beautiful wife, Rachel, and my partner, who's working with me here, tag teaming. So, however, though, we usually drive up to Plymouth Meeting and buy our juice there, and we don't have to pay that tax then.
Because we shop up there anyway.
Well, and we shop up there anyway. But nonetheless, same exact concept is what we're going to go over today, what we're talking about. So let's dig in a little bit with that. So there are dozens of different strategies used in advanced tax planning. Our goal for this event is to highlight just a few to provide an example of how you can help your personal or business tax planning. So what taxpayers are eligible for tax credits, deductions, and used to be exemptions. I got corrected on that the other day by you, right, Tammy? Right. So advanced tax planning goes beyond these standard breaks, which are offered in a way to stimulate the economy by increasing taxpayers, that the amount taxpayers have to spend or invest. So that's really the bottom line behind this, folks. We're going to get into some basics right now. I'm just going to kind of give you the outline, and Tammy's going to fill in the blanks on more of the specifics. And then we're going to move along till we can get to some more advanced concepts. And I just want to be upfront. Some of these advanced concepts are a little too detailed for me to really get too heavily into the details of. But really, we're just trying to bring them up to you to spark some interest in you possibly, pursuing or at least looking into the possibility of them working for you. So don't expect me to go a little too deep into them. If you have any questions, you can put them in the chat box. And I have not even seen the chat box on this, Tammy, but Tammy,
I've got it.
You got the chat box. We will try to address a few as we go along, but we're kind of going to try to hold them to the end if possible. Is that fair enough? Does that sound good to you, Tammy?
Yes, and I want to comment that if there are any questions, I will stay on until all questions, at least as far as I can answer them, are resolved. So I'm in no rush.
Great, awesome. So now let's talk about tax deductions. This is one of the first things you really kind of got to understand. According to the IRS, tax deductions are expenses that can be subtracted from your gross income to reduce your taxable income. So in other words, deductions reduce the amount of income you're required to pay on tax. So there's several different types. we're just going to get into a few of the original, the individual ones at the moment. First is itemized deductions. Not that many people are itemizing these days. Since the new tax code came in 2018, probably about 93%, from what I understand, are now using the standard deduction because it almost doubled as a result of it. So, and then there's education deductions, healthcare deductions, retirement related deductions. So I know you wanted to kind of, you know, break them down a little bit, Tammy. Is there anything you wanted to add to that?
Yeah, and actually, I just learned something today. But Mike and I usually parallel with each other almost on a daily basis because the tax code has just gotten way too complicated, even for accountants. And we're finding that as this tax season is progressing, there's so many things unearthed. So I worked with a client today who had a Schedule C, and we calculated, she has a SEP contribution, and calculated what she could put into. And she went to the bank and she gives me a call and says, oh, I didn't put it in a SEP. I put it in a traditional IRA. Shouldn't be any difference in that. But I went to correct it before filing it. It actually did make a difference. The SEP was a reduction of her business income, in which she gets a qualified business income deduction. Okay. So, I mean, even, you know, for us CPAs that spend our entire days working on these returns, we're still finding little nuances. But in her situation, a traditional IRA was a much better. It saved her about $1,300 in tax, just by the classification of the retirement.
Yeah, so these tax deductions can make a major difference in what the bottom line is for your taxes. So it's definitely something that you want to be conscious of. And what we're really doing is just trying to give you just a foundation of what to be conscious of as it relates to your taxes. So when you're communicating with your CPA, you have a little bit of a base to work off of.
If I can also, Brian, I just want to comment because we didn't go over this it's the other day, but with so many people taking the standard deduction, I'm finding a lot of people aren't aware that the CARES Act passed last year allows every tax return, not every taxpayer, to take up to a maximum of $300 in charitable cash donations if they're taking the standard deduction. So normally a charitable donations and itemized, but they're allowing you to take that $300 on top of the standard deduction. And a lot of people are not taking advantage of that this year.
Yeah, no, when you were mentioning that to me the other day, I was really surprised about it because obviously that, you know, being part of itemizing, in the past, there's so many things that we're not worrying about, you know, that we used to, saving, you know. Question on that though, do we have to, do you still have to have the receipts on that?
Mike, you want to take this one or you want me to?
Still have to have what? I didn't hear.
The receipts.
On the new
always have to have the receipt. You still need the receipts. And it's only for cash donations. Non-cash don't count.
Okay.
Meaning the clothings that you donated, they don't go towards it. So check or cash, you know, but it can't be non-cash.
Okay.
And in 2021, it is $300 a taxpayer.
300.
Yes.
Well, on top of that standard deduction, you really can't complain, right?
Right. No. So next year it'll be $600 for married filing joint. This year it's max $300 married filing joint.
I love it. I mean, that's awesome because right now, what's the standard deduction up to? About 24,400? Is that what it is?
24,800.
Married jointly?
Mm-hmm.
Yep, 24,800.
24,800. So you get to add 300 to that. And now, and so for anybody that doesn't understand what that means is, so, you know, if you're making, say $50,000, right? What, the first, then 24,800 plus 300. So $25,100 if you have a cash contribution and then you have a receipt, you won't have to pay any taxes on, right?
Yep.
So that's definitely something you want to keep in mind. Next, really, would you agree is the tax credits?
Yes.
Just as important, maybe more important.
Well, tax credits are always more important. You get dollar for dollar.
Right.
You know, when you look at a tax deduction, you're just lowering your taxable income. So you may reduce it by $6,000 IRA contribution, but that's not the tax savings you're getting for it. It's your tax rate applied on that 6,000, but the credits are dollar for dollar.
Right. And so, not to get too complicated with folks, but the idea when you itemize, and correct me if I'm wrong, and also the top of the line deductions, and I think we're going to talk about that in a little bit, but when you reduce your taxable income, you come to your adjustable gross income, right?
Correct.
And then they apply the tax code, right? The tables?
Yes.
Right.
Unless if you have a QBID, a qualified business income deduction, then that would be reduced. And then you come to your taxable income.
Right.
And that's where the tax gets applied.
Right. Then the credits apply, right?
Then the credits apply.
And they come dollar for dollar off the amount you actually owe.
Correct.
Right. So it makes them that much more important, the tax credits. And also too, there's two different kinds of tax credits, and that's important. There's a non-refundable tax credit, which means you get a credit, but only up to the amount you owe, right?
Correct.
And then there's a refundable tax, which means you'll actually get a credit past what you owe. And they'll actually send you cash, right?
It can be applied to your refund, yes.
Yeah. Can you give an example of the difference between one or the other?
Well, let's even look at one of the credits as an education credit, and you have what used to be the AOTC, which used to be the Hope credit. That's the maximum education credit that you can get, and that's $2,500. But only 1,500 of it is non-refundable, and only 1,000 of it is refundable. So you can take 1,500 up to the amount of tax liability you have, and you can actually get refund amount of up to $1,000. So
that's
some of
awesome.
them
So if you owed 2,500, or if you owed 1,500, you would actually get that 15 reduced down to zero, and they'd send you a check for $1,000.
Correct.
Right. So
the only tax that the non-refundables don't get applied to is if you have self-employment taxes.
Okay. Okay. So the self-employment tax, it doesn't.
Right.
Okay. So, some other examples of these types of credits there's family and dependent credits, income and savings credits, energy credits, right? I know Mike, I think Mike's going to dig into that a little bit. Healthcare credits, education credits. But the family and dependent credits though, Tammy, can you describe them a little bit?
Well, what you're going to get is for every dependent that you have under the age of 17, the credit that you get, they took the exemptions away in 18 that would reduce your taxable income by $4,000.
Right.
And they created $1,000 child tax credit instead. Now that's gone up to $2,000, and it's going to increase again for 2021. Still getting, word on that. But so for every dependent that you have under the age of 17, and their age is dependent on what they were December 31st. So I had a client ask me their child turned 17 in July, so they're going to get half the credit for them. It is all based on the age of the child as of December 31st. If you have a child over the age of 17, then you only get a $500 credit, and then any other dependents that you have. And that is anyone who's living in your home, earning less than $4,800, and that you're providing more than half of the support. And the only other people other than your children that have to live in your home to get that credit would be your parents. If you're providing more than 50% of their support, and they're in a care facility, you could take them as a dependent as well.
Are they fundable or non-refundable credits?
They are a hybrid. So it's non-refundable up to a certain extent. If you qualify with income, then you can get it refundable, but you have to meet those qualifications.
I see. I see. So it could be either or, depending on your income. So just showing you the importance of the tax credits, how important they are. Income and savings credits, how they apply.
Do you want to take this one, Mike, or do you want me to run with it?
Keep on going. That's fine.
Okay.
I'll add to it.
So not only do you get a deduction for any type of retirement contribution that you make, if your income is under $50,000 and you contributed either through the 401k with your employer, or you contributed to an IRA or any type of retirement account, you're able to take a credit on your return. It's a retirement savers credit. The only time that would be excluded is if you're under 50,000 and you're already receiving income from a retirement account.
I see.
Whether it be a pension or, you made a distribution from your IRA, you wouldn't be entitled to the credit. You'd still get the deduction, but not the credit.
Right. So you're actually getting it on both sides. It's a deduction and a credit when you're saving. So they obviously put a lot of incentive out there for folks to put some money away.
So something really, you have young adults that are still living at home with mom and dad. They get a decent job. They're in a low tax bracket. What you do is you have them put into a Roth IRA. They pay the tax going in, but they'll get that credit, and then it's all tax-free coming back out.
Wow, that's some great stuff. I know that Mike, Tammy said that you have a lot of knowledge on the energy credits. So I'd really love to hear some of your feedback when it comes to that.
Well, the energy credit is a good thing, but there is a lifetime maximum of $500 on it. The residential energy credit also did expire at the end of 17, but you can still go back and amend returns and take it for 18 and 19 for anything that was installed prior to December 31st of this year.
Yeah, can you explain to people what has to be done for you to qualify for that credit?
Well, the credit has to be qualified energy efficient improvements, and you have to get something from the manufacturer that says that it meets the requirements of the credit, because it has to have a certain amount.
Could it be like a new heater or new?
It could be a heater, or an electric heat pump, a water heater, fuel stoves, high efficiency central air conditioners, natural gas pipeline, oil heaters. They all will qualify.
How about like a new front door? I know that they used to. Not anymore.
The windows, the exterior windows and lights are limited to a $200 maximum.
I see.
So there's only a maximum credit, and the credit's 10% of the cost.
Right. Okay. Okay.
It's not huge.
No,
it's still available.
No, it's still available. There are credits now, though. There is credits for energy efficient property, like solar heating, solar electric, fuel cells, small wind energy, geothermal heat pumps. And that is available through 2023. That credit for 2020 is 26% across the board, and it will stay at 26% through 2022. In 2023, it goes to 22%.
Really? Okay. I guess we'll have to see what evolves with that. It's my understanding that this new administration wants to put a lot more into the green energy. So hopefully that, comes into maybe a more liberal tax code, so to say. And we'll see. We'll see. But 26%, 23%, that's not anything to sneeze at. It's something, that's for sure.
That's true. And some of these things are qualified for rebates from your energy company. Like PICO has rebates if you do some of these things.
Okay.
So it's not only the tax credit, there's other rebates that are available.
Huh. And when you say rebate, maybe it's like $100 or,
Oh, no. From what I understand, it can be a couple thousand, depending on what you spend and what you do, especially for solar.
Really?
Yeah.
Well, that's definitely, so you got some good motivation in that direction.
Yeah.
That's awesome. All right, well, you got the healthcare credit and the education credit. What are your thoughts on that, guys?
Well, the healthcare credit, if you're in the marketplace, you can receive a premium tax credit. And when you go in and put your application in for the marketplace, you're giving them an estimate of what next year's income is supposed to be. And they say, well, based on your income, we're going to give you a credit towards your premiums. That now has to be reconciled on your tax return. So they'll issue you a 1095-A at year end saying, here's what your premiums were. Here's the credit that we gave you. And then if you underreported your income, you're going to actually have to repay back some of that credit.
Right.
But if you overestimated your income, then you're going to get that back, what premium tax credit you were actually entitled to. So that can help. It can also bite you in the butt.
Right.
You know.
And for 2020, the new act that they passed 2 weeks ago is if you owe any credit back, that's waived.
Really?
Yeah.
Yeah.
Wow.
Yeah.
That is great news.
But Mike,
Exciting.
correct me if I'm wrong, you still have to, for it to be waived, you have to be under 400% of poverty, right? Poverty times 4?
No, no, the 400% of poverty is to qualify.
Okay, right.
And
For
it's changing.
wait.
It's changing from 400% of poverty. This is for 2021 to 8.5% of your income.
Wow.
So
Okay.
if you make 200,000 and your premiums are $18,000, it's more than 7.5%. You will qualify for the credit.
Wow.
So they've changed that with the new act. That's only for 2021.
Okay. So we'll see where it goes, but I mean, that's definitely in the right direction, I would think. And, you know, I think some people are glad to have heard that information. You guys you're getting it right, you know, hot out of the oven, I suppose. And that's great. What about the education credit, Tammy?
Well, the education credit, you know, we kind of touched bases with it with the AOTC. The AOTC is only available for the first 4 years of college. That's the big one, the 2,500. If you don't meet that, or you're a graduate, or you're not a full-time student, don't meet the qualifications for that, you can still get a lifetime learning credit, and that's a maximum of 2,000. And then the other thing that you have is, and you can compare all three to see what works best for you, is to take a tuition deduction where it lowers your taxable income. And that usually works best for people in higher tax brackets because they're lowering that taxable income where you still get the same dollar for dollar. So one of the tips that you can do is, you have a student that is full-time and started school in September that year, and you've only got one semester of tuition payments. You may want to hold off on taking that HOPE credit until they have a full year, and you can maximize that and just take the lifetime learning in that year that they're only the full-time student for that half a year.
So that's on a year-to-year basis. And you're saying you can do that the first 4 years, right?
First 4 years for the AOTC, or you get 4 years for the AOTC. Doesn't have to be the first 4. And unfortunately, most kids are doing college in 5 years.
Right. Right. Yeah. So that's what undergraduates becoming these days, right? Okay. All right. Well, obviously, folks, if you have any questions about it, we dug in a little deeper on these, because these are kind of like the foundation. Would you agree, Tammy?
That is. That's basically the foundation. Yeah.
Yeah. The foundation between your deductions and your credits, getting a firm understanding of those, fundable, non-refundable, and refundable credits, understanding. We mentioned at least the nature of them. Look, you know, we're not really trying to have everybody out there going to think they're going to be a tax professional after this webinar, but we just want to kind of get you clued in a little bit, educate you enough to, you know, at least inquisitive enough to really pursue some more knowledge on these things. Do you agree with that, Tammy?
Definitely.
So, you know, on that note, you know, we definitely encourage that anything that we talk about today, you collaborate with either a financial professional, financial advisor, and a CPA. Like Tammy said to me the other day, we were talking about this, both preferably and possibly even your tax attorney in some cases, right? Because we really think that these should just wet your whistle, and then you should engage with your professionals to find out more. Would you agree?
I would. What we were saying the other day is I like that triangle where the accountant, the financial advisor, and your lawyer all work together, because we're all coming from it with blinders on, focusing on the area that we know best. And sometimes what I might advise to you for taxes may not be that great for you from the financial end, or it may not be a good estate planning tool. And that's why those three should collaborate and make sure that we get that healthy balance of what's best in your best interest every time. And I do have to add, Mike actually just had a conversation and explained pretty well, and they're reaching out to the Philadelphia Inquirer, but Mike, about the tax implications that are coming through. And I've never been one to tell people not to self-prepare taxes if they were intelligent enough. But with the changes that have been coming down the road, what we see coming, there's nothing simplified. And I truly can't, unless if all you have is a straight W-2, I really advise everyone to seek a tax professional for their tax returns.
Yeah, and on that note, really, that's kind of how Tammy and I met. I'd called around to a few different CPA offices to try to create kind of a mutual relationship to, introduce some of my clients and vice versa to each of our niches, if you would say, because things really, when you really want to try to assert yourself in these types of tax reduction situations, and I think her and I really saw eye to eye on this, was that everybody kind of has their own wheelhouse of those different professionals that they kind of work with, and it really works better as a team. And she reiterated that to me yesterday, even going through this presentation. So just wanted to put that out to you. Another basic, kind of tax 101 thing is just to talk about your tax brackets. I guess the one and only thing that I ever really try to talk about with people with this is understanding, one, that there are 7 tax brackets at the moment. There's your 10, 12, 22, 24, 32, 35, 37. But if you don't get anything else out of this webinar, and it, I think it drives every financial professional a little nutty to hear so many people think that if they have any income in any one of these brackets, that they're paying that full amount on their whole income. And absolutely nothing could be, and I've read this in trade magazines. They lay things out like that. It drives me up a wall every time I hear it. So Tammy, you want to kind of break that down for people a little bit, how that works?
Right. So the federal tax is a progressive tax. Basically, in a nutshell, the more you make, the more they take. So, the first 10,000, 19,000, almost $20,000 that you earn, there's no tax. And then you pay 10% in the next bracket. So each time you hit the next level, you're paying that higher tax.
Right. So you really only have not little, but portions of your income taxed at every one of those bracket levels.
Right. So what's really important is you should know what bracket you're in. And I work with clients to make sure that we know what the next level bracket is. But the most important thing to know from your return is what your effective tax rate is. So when all is said and done, and they taxed it at the progressive level, and we've taken our deductions and we've taken our credits, for every dollar that you bring into your household, how much goes to Uncle Sam? And that effective tax rate is more important than what bracket you're in.
And that's the simple tax rate, right? So say for instance, if you made $100,000 and your effective tax rate was 14%, right? Then you actually paid $14,000.
Right.
Right. And that is the important tax rate. Now, when people say what bracket you're in, they're referring to what did your last dollar fall into, right?
Right.
So you may, I think I actually I looked up the new ones for 2021, and I think the end of the 12% tax bracket ends at like 40,525, somewhere around there, right?
For a single person, it's
For a single person.
40,125.
What is it? Say that.
For a single person, it's 40,125.
Okay, 125. Okay, so
Yep.
if you make 40,126, you have $1 in the 22nd bracket, right?
Correct.
That's getting taxed at 22%. $1. So you may be in the 22% bracket, but you're nowhere near close to paying 22% in taxes. Is that a good way to put it?
It is, but then also to consider that every dollar that you increase above that, that is being taxed at 22%.
Absolutely.
So,
Absolutely.
the big hike is where you go from 24% to 32%.
Yeah.
And that hits at, for a married filing joint at 326,000.
Right.
So when you have clients reaching that level, that is a huge jump. And there's a lot of planning that needs to go in to keep you out of the 32% bracket.
Absolutely. And a lot of that, would you say that these deductions and credits and these types of things and some of the other things we're going to talk about are strategies to do that?
Correct.
Absolutely. So, and these are facts related to it, but there can be strategies that are implemented utilizing these pieces to the puzzle in order to effectuate that, right?
Right.
Okay. So anyway, just wanted to drive that point home because I see that as tax 101, right? Right. Okay. So just a couple, I guess housekeeping things. How long should now? I got really schooled on this the other day, folks, by Tammy about how long you should keep your receipts. The short answer is the IRS says 3 years, right?
Yes, that's what it says, but you want me to school everyone?
Yes.
Okay. So normal audit period for the IRS is 3 years, and that's the standard answer that everyone has. However, the IRS, if they feel that you have negated income, and that's mostly with your Schedule C businesses, they can go back for 7 years and audit your income. And
when you say negated,
not reported.
What's that?
Not reported.
Not reported, right.
So they're looking
evasion,
for,
right?
Yeah. So I tell my clients, especially my Schedule Cs, and I've had this happen where contractor, had $50,000 in deposits in his bank account, reported $40,000 in income on his return because 10,000 of it was reimbursed expenses. So he lowered his costs, would get audited by the IRS. And they said, look, $50,000 in deposits into your bank account, we're assessing you that 10,000. Since they're auditing that, we can now open up the receipt side of it and the expenses, and then we can counteract with that. So just because the audit for 7 years is on income only, save those deductible receipts. And then, of course, in cases of fraud, the IRS says that they can audit indefinitely. The only times they've ever done that is in cases of the mob and drug cartels. So that's how they got Capone. And they can go back indefinitely in those cases. But I don't think anyone in here has to worry about that. I hope nobody in here has to worry about that. However, in 2016, Pennsylvania did an amnesty program shortly after they converted from one computer system to another. And they started sending out notices saying, hey, you didn't file back in '03. And as preparers, we came back and said, well, wait a minute, we've got a statute of limitations here. You can't go back that far, you know. And Pennsylvania very clearly laughed back and said, oh no, we don't have a statute of limitations.
The state of Pennsylvania.
State of Pennsylvania.
So not at the federal
So-
level, but at the state, it
Right.
may not have a statute of limitations.
So in 2018, and Mike, I believe you were there that day as well, the PA Society of Tax and Accounting Professionals, we went and lobbied in Harrisburg, and there was a bill put on the table. I've never lobbied in my life before, but it was my first time. And we got the bill. We talked to congressmen over in Harrisburg. The bill got passed, and Wolf signed it into action November of 19, that Pennsylvania now maintains a 10-year statute of limitations. I don't like
Woo!
it, but we've
You guys
got
did it. Nice. Hooking everybody up.
the long story short, I tell everybody now, maintain for 10 years, because that's how long Pennsylvania can come back after you.
Okay, so that's some schooling, right? Right. So I hope everybody enjoyed that little tidbit. You wouldn't have got that out of me alone.
Okay, Mike, you're
I have
adding.
a record retention chart that I just copied into the chat.
Thank you. I saw that, and everyone else can take that and download it.
Because
Thanks, Mike.
there's different retention periods for different things.
Yes. I didn't want to get that far into it.
Okay. So
But there
just,
are-
you know, what the big print says, what's the old saying? The little print taketh away. Right. So, but at least you heard it from the experts, folks, because again, like you would not have gotten that from me. And I am reading some notes here because I want to make sure everybody gets the full details of things. Some of these things, you know, they get there's a base to them that I want to get across. And I certainly am not the tax professional, but you know, I just want to make sure that you get a few of the actual facts and then the lowdown. And I think you guys really gave us the lowdown. So let's talk now. Another housekeeping item. So hard copies, digital, like tax records. Well, first of all, so the breakdown of all the different types of income receipts, you know, expense and deductions. You know, I will read real quickly because this is kind of one of them, you know, very specific things. Income documents, W-2s, obviously, bank statements, 1099 forms, brokerage statements, alimony receipt, K-1 forms. So that's all income related documentation. You want to add anything to that?
I do. And mainly because it's been an issue. The IRS will accept digital. You don't have to have the original print. And one of the things that we found, you know, when you look at your receipts that you hold on to, those laser prints on the thin paper, in a few years, they fade and disappear. So I highly suggest digital for the receipts. And I'm not a sales rep. I don't get commissions, but I use a program called Neat Receipts, where you can just scan the receipts. It'll tally it up and hold on to it.
You want to put that in the chat? What's it called? Meat receipts?
Neat Receipts.
Neat
I'll
receipts.
get a link for their website. I've been using them for years, especially with my shoebox clients. They come in with their receipts and I just throw it into the scanner and it prints out a report and says what the expenses were for me. So, but it keeps a scanned document of that receipt. It will never fade.
And don't they have, ones where you can take a picture of it too?
There's a lot of apps out there. Yes,
Yeah.
I have the Neat Receipt app on my phone, so I can just take a picture of the receipt.
Yeah, I mean, they make it a lot easier. I have to convert to that myself. I'm an old dinosaur holding all the, and I got on my walls, I got 4 years worth of receipts I'm looking at, right?
So,
and they fade, right? It's a nightmare.
We've heard-
Plus, you got different people that in your business, like my brother and I, and you know he's bringing up some, and you know his table at his house has got like literally looks like a giant snow mountain of receipts and you know invoices and all that stuff. So I actually need to heed that. I was thinking about that today. And I want you to put that link in there so I can see it myself, actually.
The link for it is in chat. And I'll tell you, my contractors and landscapers that are on the road all day long, I've gotten some of them to sign up for this, and they're out there. They have the app on their phone, and they take a picture of the receipt, and they can throw the receipt out at that point, you know.
And what does something like that cost?
Oh, good question. I think it's like $350 a year, but they have different levels that you can get. I have the full blown, but you know, when it preserves, I've heard of horror stories of people going into audits, and they go in with their, you know, portable files that are all organized, and they have everything in order, and they pull the receipts out and they're blank.
Right.
You know, and depending on the agent, depends on the results of how they handle that.
Well, certainly anybody with a small business, that's a business expense, right? So that'd certainly be worth it.
Yes. So there you go. That's a tax deduction off of your business.
Yeah.
In addition, excuse me, in addition to keeping the receipt, you also have to have proof of payment. The regulations require both.
And what does that entail?
Canceled check,
Bank statement.
bank statements that you paid your credit card bills.
Okay.
Okay. So it's not just the receipt, you need both.
Right. I see what you're saying. They can't make anything easy, can they?
Right.
Too thorough. But you know, home closing statements, purchase and sales invoices, insurance records, property tax assessments, retirement accounts. Here's one that I actually just ran into myself. That went backwards on this. That I thought was kind of interesting for retirement accounts. That form 5498, when you make a qualified contribution or an IRA contribution, I had a client asked if she needed that. She did not get mailed that. It is held, the custodian sends it into the IRS herself, at least at TD Ameritrade. So there are some though that you at least need to know who has it, right? And the same thing with the 8606, which is non-deductible IRA, 401k statements, distribution records, annual statements, that type of stuff. And then it even talks about transaction data, including individual purchases or sale receipts, annual statements. So you were talking about even something like, I guess, any kind of investment that you might make. What about, like you mentioned, Bitcoin or something like that? That would be probably, I guess it depends on where you buy it. If you buy it through your custodian or within your retirement plan. But all those things would probably come on your 1099, right?
Yeah, if
Right.
you're doing it through a brokerage. Yeah, the Bitcoin is also bought and sold on other platforms that aren't issuing 1099s, and that's where the IRS is having a very difficult time with getting the capital gains on Bitcoins reported.
Wow. So keep that in mind, folks. You want to buy any Bitcoin, everybody's talking about it.
Every transaction has to be reported.
Yep.
Right. So, all right, that's some good food for thought too. Storing, we talked about that. You're saying preferably digital, right? I mean, opposed to hard copy, but hard copies just as well, right? These days they'll take it, right? So really, if it's on a flash drive, they'll take it. You know, anything like that, which I guess we'd still consider digital. So. Anyway, digging a little deeper. What's that?
It's getting.
Okay, Rachel's getting a little disoriented over there. All right, so we're back on track here. Okay, so I'm actually gonna talk. We're talking a little bit deeper with deductions right now. So, you know, what's going on here? So, let me find that. I don't see that. Okay, well, we did talk about 3 different types of deductions, and you included the exemption. I did think of something though, Tammy. We are, and maybe you can and give us some detail as it relates to it. But 2027, are we scheduled to go back to the pre-2018 tax code?
I'm going to pass this one on to Mike because he is more up to date on what came out on March 8th than I am.
What's going on with that, Mike?
Yes, they haven't changed that.
So far, we're still set to do it. There hasn't been any.
We're still set to do it. Yes.
If that happens, we will have exemptions again then, right?
Yes.
Right. So, I mean, we got hurt on that a little bit. Family of four, right? Used to get $4,050, right? And then the child credit went to what, 2,000?
Right. So actually, I calculated it out, Mike, if my math is off, but when it first came out, if you paid under 18% effective tax rate, you got a benefit from that change.
Okay.
If your effective tax rate was over 18%, you were getting hurt.
I see. Okay. Yeah, I hated to see those exemptions go, but I guess when you tie it all together, at the end of the day, I know the software I have, when you revert, and you can revert to the pre-218 code, you always see higher effective rates. So at the end of the day, it did work out for most people, right?
At the end of the day, what we saw over and over and over again with this was the largest tax change since the Reagan, era.
Right. Yeah.
And most of the people were within $1,000. It either helped them $1,000 or hurt them $1,000. The people that hurt the most were professional singles.
Right.
Right.
That makes sense. So anyway, there are lots of different, really hundreds of different types of deductions, right?
Yeah.
Yeah. So we only mentioned a few that had to do with individuals. And at some point, I think there's a slide that we're actually going to dig into that a little more. But anyway, talk about strategies that apply to your for your W-4, right? Now, this was another one. Now, so I can just tell you folks a little bit what would go on with me, a little bit of guidance that I would give, but as a financial advisor, mind you, we're always trying to get return on all the money we make, right? So, but so many people are really, I guess, they're attached to the idea of getting a refund, right? And so, but I'd rather see people break even, have that money in their own pocket, invest it, and get a return. So this is where a W-4 and a strategy related to how what you put on that could help you. And in fact, I know the IRS actually has a calculator. And I used to go to that, and you can figure out, based on your dependents and your allowances or what have you, what to put on there to break even. And then it would put just enough more money in your pocket to know that you're safe with not owing them, but they're not holding your money and then making interest on it instead of you. And so that's the biggest concept that I've, strategized using a W-4 with. What are your thoughts? Any strategies or thoughts that go into it? And I know you dug down a little the other day. I'd like people to hear that.
Right. So ideally, with every return that I do, I want to make sure that they're getting a refund back so they don't have to cut checks. But I don't want to see that refund over $1,000. That's the window that I want to keep everyone at. Of course, I have the clients that like the $5,000 refund because that's their trip to Disney, or their vacation every year. But if you have that, you're giving Uncle Sam an interest-free loan. You're giving him that money all year long, and he's not paying you any interest on it. Take that money, have it put into your savings account or invest it. And then when you get your tax return filed, you're going to have more than $5,000 sitting in your bank account. But it's hard to break some of the people of those habits. But the W-4 was updated, and we've always used this as a mechanism to adjust your refund by increasing or decreasing the number of exemptions. But exemptions are gone. and they updated the W-4, and I absolutely hate it. If you have married filing joint with both husband and wife working, or if you work more than one job, so there's multiple incomes in your tax home, they have a worksheet for you to fill out. And if you follow that worksheet, you need to identify what your spouse makes or what you make at your other job. And you're handing this form over to your employer. That employer has no business knowing what your spouse earns or what you make at another job. And I just completely, it goes against every grain I have. Now, you can, on the first page, instead of doing the worksheet, you can tweak by increasing or decreasing the number of dependents that you're claiming. So if you have a dependent under the age of 17, that's going to make a $2,000 difference on the withholding. If you have an other dependent, it'll make a $500. So you at least know exactly. If we have a $2,500 refund, we can add an extra dependent. You won't get in trouble by putting the wrong dependents on your W-4 unless if you end up owing tax. Then they can come after you and assess under withholding penalties. But you can, add an additional dependent because you have so many deductions. You don't want that much tax being withheld. The other
I guess
thing
this would be an instance where we would say, definitely consult with your tax professional.
Right. And what I've been doing with most of my clients, because every time we review a return, that effective tax rate is something I point out. And I've told people that have been like, what am I supposed to do with my withholding? And I've had them go back to their employers or human resource and ask them to withhold at that effective tax rate. Or
that's what I got out of the conversation we had the other day. I never really heard anybody approach it like that. But that is a great way to be so specific. And you said they will actually do that.
They will. Most, I haven't had any come back and say their employer's gruffed, although I know QuickBooks payroll subscriptions, you can't put in a percentage for flat tax. So if any employer used QuickBooks payroll to process payroll, they would have to manually calculate it.
I see.
So it does pose a problem there.
Right.
If it's a small business, 1 or 2 people, not a big deal. So, the employer might give some gruff on that.
So all under the auspice, though, you'll have a break even, right?
Yeah. And if the person says, listen, I want 1,000 back or something, then let's
Right.
increase. Or we think our income's going to go up. Okay, let's increase. And I always do a tax projection for the next year. And we look at the effective tax rate we're expecting for the next year as well.
All right. Well, then we're preaching to the choir here, right? I mean, both of us, I think that is a little more granular, a little more specific. I think that's a great way, an approach to go into your employer to talk about. Tell them you want your, find out what your effective tax rate is from your tax professional or your financial advisors. A lot of them, like myself, have that software too to do that. And, I would still check it with your tax professional though, and then go in, use that specific number. If you indeed want to try to do a break-even system, that probably be your best approach, right?
Yeah.
Okay. All right. So moving on, just covered that. So now let's talk about a 401k. Now there's some interesting things. So I am going to read this just because I want people to have the true definition. Okay. Rachel's a little sensitive to me reading the things too, but okay. So a 401k is an employer-sponsored plan offered by some employers. The goal of the 401k is to help to save for retirement. One benefit of funding your 401k account throughout the year is that your contributions can create a tax break. So, and then the IRS doesn't tax you I kept messing this up the other day. The IRS doesn't tax what you divert directly from your paycheck into your 401k. So basically then it's pre-taxed, right? So it's pre-tax money that goes in there. I think most people know that. Okay. If you don't, that's what's happening. So basically you make $100,000 a year and you're putting $10,000 into your 401k. you're only reporting then 90, right? Okay, so that goes in, that's your starting earned income, right? On your 1040. So there are interesting things when it comes to a 401k that I talk to people about a lot of times. One is obviously the contribution levels far exceed what you can put in an IRA. So right now, if you're pre 50 years old, you can only put $6,000 a year in. If you're post 50 years old, you can put $7,000 in an IRA. At the moment in a 401k, if you're pre 50, you could put up to $18,000 a year. And if you're post 50, you could put an extra catch up $6,000 up to $24,000. Now, you could actually get into strategizing off that. I've actually had people who came in who were eligible for their Social Security, right? And still working. And they, not that I advocate all the time, only special situations, but they take their Social Security benefit and now they reduce the amount of their income to divert it to their 401k. Right? That could be a strategy for saving more tax deferred. Right? So there are different, and if you had a solo 401k, so if you were self-employed, you're trying to catch up on your retirement, this happens with a lot of folks, you could put up to, I believe, around $62,000 a year into a solo or an individual 401k. Right? So it's really a tremendous vehicle for reducing your taxable income in so many ways. And that's not even to mention, and maybe you can get into this a little bit, if your employer has a profit sharing plan and they're offering a match, right? And I've seen matches as high as 6%.
That's all tax free.
Exactly, right?
You just gave yourself a raise.
Explain how that works a little, can you?
So if you put into your 401k, and let's say we'll use your example of the 100,000 and you put 10,000 in, you're paying tax on that 90,000. Let's say your employer does a dollar for dollar tax, or match. You just gave yourself a $10,000 raise. Now, most employers will do a half a cent on the dollar, max of $3,000 for the year. But whatever they match you at, that is not appearing on your W-2. You are not paying tax on that income, and you just gave yourself a raise. And then it's all growing tax-free, because when you pull it out, you're not paying any income tax. So the
you
growth,
doubled your savings, right?
right?
What I tell people when we do that is that if your employer is matching 50 cents on a dollar, where are you going to earn 50% on your money day one?
Exactly.
Because that's what you're doing.
Absolutely.
Yeah.
So, I mean, 401k is a tremendous vehicle for so many different reasons. And that's whether you're employed or self-employed. You know, most have some, and that's called, the match is called the profit sharing plan, right?
Mm-hmm.
So most have that, not all. And if they don't have it, they're not matching, and you don't plan on putting more than what you would put, what you're allowed to put into an IRA, I'd probably go with the IRA, because there's less rules, you have more control, you can control what you're investing in more. So you know, there's but other than that, I would say a 401k every day of the week, right?
That's the number one go-to. I mean, if you have an employer that's offering that, it's the simplest, but it is the number one go-to for any type of tax planning. And I've even pointed out where people are like, I can't afford to have more withheld. But if we take a look at their tax bracket, and they're heavy into the 22%, you know, so if they take an extra 3% out of their pay, they're saving 22% on that earnings from their taxes. So when we lower their taxes from them doing it, they're like, oh, Okay, well, yeah, now I can afford it.
Right, because they don't realize the tax benefit of what's going to happen by staying out of that bracket, right?
Right.
So yeah, can't say. And then by the way, the equivalent of that, you know, if you work at a nonprofit, it was like a 403B, right? And then there's also some, it might be a little different, but a 457B, right?
Right. And Brian, I have to interrupt you. My dyslexia kicked in earlier when I was saying, so in a 401k, you are paying tax on the end. Okay, but you're getting that extra income. It's the Roth IRA that you get tax free. So
Right,
I had
you
to
know,
correct
yeah, and that was
myself.
actually the
I
next thing I
slipped.
was going to say. There is a Roth version of this, and we're going to talk about that actually right now. We're going to talk about that as it relates to IRAs, okay? But you know, obviously, from on a personal level, if you don't have a 401k available to you, and you are employed, right? Because you do have to be employed making earned income to have an IRA, right? You know, the IRA is the next best thing. Would you agree with that?
Yeah.
And you know, so one of the things that I like, and just to, you know, drive down the tax benefit to an IRA as a retirement account, if you do whatever you put in that IRA, is they are going to reduce your income by that amount prior to applying the tax rules, right? Or the tax code or what have you, right? So you're really reducing your income by whatever the amount is you're putting in. That's called a top of the line deduction, right? Right. And so really, you got to keep that in mind too. A lot of times what people would do is they'll wait to the end of the tax season, right before they file taxes. You guys let me know if I'm wrong with this. And they'll determine how much they owe. And then they might make a decision because they allow you to make your contribution for this year. They'll actually allow you to make a 2020 contribution all the way up to tax deadline. Now, they allow them that to go past the 15th this year?
Mike?
Yes, they announced that the other day. That can go up to May 17th.
So the IRA contribution, same thing, right?
Yes,
You can go all the way up to this year. It's going to be the 17th of May. Just got pushed back.
correct.
But all the way up to that time. And the reason they do that is to give you a chance to figure out what you owe so you can determine if you want to reduce that by the amount you put in, right?
Yeah. And if you're self-employed and have a self-employed plan like a SEP or something like that, and you extend your return, you actually get till October to make that payment.
I mean, so
But that's
really
only,
understanding that they're giving you every advantage to try to reduce your taxes by what you contribute. So who
Correct.
would you rather pay? You or the IRS? Right? So this is something I think a lot of people really need to understand. So because you'll pay a higher tax if you don't contribute to something like this. So I highly encourage it. And then the other version of this, obviously, and I'll explain the difference, is a Roth IRA. And the main difference between a Roth IRA and an IRA is in an IRA, they're going to allow you to deduct that from your income for that year that you contribute. But when you go to take distributions, they are going to tax it at whatever your income level effective rate is. So the theory is that hopefully by the time you retire, and the way that Social Security is taxed a little differently and less, okay, is that you'll be at a lower tax bracket when you go to take those distributions than you would be when you're contributing. So you're kind of deferring it off. Now, you are going to pay tax on the growth as well. And depending on how well you do, it could be a good bit more. Okay. So the flip side of that is you could open a Roth IRA, or in some instances, it's you could even have it. They also, most employers are offering Roth 401ks these days too, right? And that is post-tax money. So you're going to pay the tax on that now. And then when you take the distributions at a later date, you're not paying any income tax. Does that sound accurate?
Yes. So that's the one. That's where I got my dyslexia. The Roth grows tax-free. So if you
Grows
put into a
tax-free.
Roth 401k,
They both grow tax-free.
They both
Right?
grow tax-free,
They
correct?
both grow tax-free. So they're
Tax-free.
giving your advantage to both. Okay, same advantage in terms of growth. What the major difference between the two is that you're going to not pay taxes today on one by getting that deduction, and the other you are, because you're not getting the deduction, but you're going to get the tax out later on, and you're not paying tax on the growth.
right. So the good time that the Roth is in, like I said, a young person just coming out and they're just getting earnings, but they have extra money, put it into a Roth, pay the 10% tax now, and that'll grow. It also is an excellent strategy that if you have a teenager that's working and they're going to put the money aside for college, they could put the money into an IRA. A Roth IRA would be best. And that money doesn't get attributed to the FAFSA for their financial aid. So it really is an educational savings account or a college savings account vehicle that's even better than 529 sometimes. But
yeah, I've heard that compared. I mean, there are obviously some subtle differences, but whether you're going to report it for college or not is really a biggie, right?
That's huge, because any income that is in a student's name, or not income, any assets that is under the student's name, such as the 529 plans or ESAs, is going to be assessed for financial aid at 50%. So if you have a student that has $10,000 into a college savings account, then they're going to, 5,000 of it is going to be expected to pay for that first year of college. And then the next year, 2,500 of it, and then 1,250. If it's in an IRA or a Roth, then none of it is counted. It's at 0% assessment. So, and then you can pull it out of the Roth to pay for college, and there's no penalty. And so you have the funds to pay for the college. If it's in a Roth, it's not going to increase your income, which also decreases financial aid. So it's a win-win-win across the board.
Absolutely. And that is great tax planning. That's great college planning. I mean, that is where the value is. Absolutely. Well, another strategy that I'd like to talk about with folks when it comes to Roth IRAs, because I deal mainly with folks 60 to 80 years old. They're just, either just retirements, they're in retirement, it's eminent, or, have been in it for a while. And I see them taking withdrawals to pay their taxes. And sometimes those withdrawals are handsome and get a lot of complaints about them, I have to tell you. And then the following year, they're paying taxes on the money they took out to pay taxes, right? It is not pretty, folks. And what my recommendation is to create a balance between these types of accounts. And what you want to put some thought into with these, and I always encourage all my clients to do, is so most people have at least some type of bucket list when they're going in retirement, right? And whether it's going to be that dream vacation, renovating the kitchen, buying that new car or new truck that you want, right? And they want to just whack it out to the IRA, out of the IRA. Woo! The taxes go through the roof that year, right? And now suddenly you may even shift, depending on what your income is, up to have to pay more for your Medicare. Right now, you can file certain forms, right, for exceptions, okay? And I always talk to folks about that, but that could take a couple of years, right? So it really makes more sense, in my opinion, to give some thought to this. My strategy is, if you're pre-retirement, is to give thought in balancing them to where you know, a reasonable return, right? You would get, and on that, what reasonable return would I get if I put this amount? And how much do I think I'm going to need for them lump sum, you know, distributions to go towards this bucket list? So you at least have some type of tax-free income to pull bulk numbers from, okay? And then you're not getting hit with these massive tax bills that I hate to even have to do the withdrawals for, quite frankly, right? So that, and then if you do come to retirement, this is when a lot of people will consider a Roth conversion, right? And we talked about those tax brackets, and I'm not going to get deep into this, but the end result is that you could pay a little bit of tax. You could put together a system that you put together, that you work with your tax professionals to do, right? Where you would move X amount over a certain amount of time into a Roth account, pay the tax. Now's actually a good time with tax rates being as low as they are, right? And then as a result, you could end up, especially prior to 2027, when we know the rate, the tax rates are going to go up if it doesn't happen before that, right? And now and that's even, you know, now you got that, you know, bucket to take those, you know, if you're going to need a lump sum here and there, you have a tax-free bucket to take it from. And that's a major thing that I advocate to my clients, that I think a good strategy could be put together for most folks, to at least get that much out of it. You could also, benefit would be, you could lower your RMDs.
I was
right?
just going to say that.
Yeah. So, you know, you want to explain the RMD?
Yeah. So in an RMD and the Secure Act that was passed in December of 19, it used to be that if you reach the age of 70 and a half, you're required to take a required minimum distribution from the total sum of all of your IRA accounts, and take it out every single year. With the Secure Act that came through December of 19, they raised that to 72. So it basically it's not a flat amount. You put your age in, you put the amount of money that you have in, and a calculation is determined as to how much you have to take out. When we do the RMD calculations, you have the total sum of all of your IRA accounts. It does not include Roth. So I just worked with a couple this past week that they're in their mid 60s. They were both working up until 19, where they were forced into a retirement. When they were working, they were in the 24% bracket, and they maximized on all of the contributions that they could possibly take to keep their tax down. Now they're retired, and they're actually down in the 12% bracket. And they're looking at the RMDs that they're going to need to take in the next 6 to 7 years. And it's going to throw them back up to the 22. So we are taking out distributions each year that's keeping them in the 12 without putting them over, but transferring and doing a conversion where we're taking it out of the IRA and we're putting it into the Roth. And so by the time they go to retire and hit, or they're already retired, by the time they reach their 72nd birthday and look at their RMDs, it's going to be brought down into a lower bracket, and they won't have to take as much out. And if they need the money to live on, then they have a Roth and then can pull that out tax-free.
Now,
So
if you have hospital bills, whatever, any larger lump sum amounts, you really can't replace a Roth, right?
Right.
So it's a win-win without a doubt, because you're going to lower your RMDs, you're going to pay tax at what now we know to be a lower rate, and as a result, you're going to have a nest egg of tax-free money to be able to draw lump sums for whatever you may need them for or want them for. So definitely some good strategizing that can be done between Roth IRAs and IRAs. And you can also do that strategy between a traditional 401k and a Roth IRA for early on for planning for these things. So a lot of great things to talk about when it comes to IRAs and Roth IRAs. So we're going to hit a couple of, very quickly, a couple of other types of tax advantage accounts. One's called a flexible spending account. I guess right out of the gate, what I'd like to say about this is, number one, it has to be done through your employer. So you have to be working, okay? And this is kind of set up like an IRA would be, right? Where, now there's a limit. Your contribution, I think for this year is still $2,750, around there, the maximum, right? But you will then be able to put pre-tax money, reducing how much you're going to report as earned income on your tax return by that much. The thing is, you have to spend that money within the year that you contributed, right? Well, there's actually one exception to that. And in my due diligence for this, I realized they do allow you to roll that into a health savings account at the end of the year. And some employers will allow you to keep up to $500 or $550 of that. But if you don't spend that money on these qualified medical expenses, and there's a long list. I looked at the list, it's 60 pages plus of the different types of medical expenses that and dental expenses and what have you. And chiropractic is on the list because that's a big one for me, and it's not covered by a lot of plans, right? So you can get a tax break at least for spending your money on chiropractic, right? But you got to be employed. $2,750 is the max. You gotta spend it within that year, and what you don't spend reverts back to your employer, even though it was your contribution. Am I right on those? So certainly, though, a good option to have to reduce taxable base more, right? Would you agree, guys?
Yeah. And you do get 2.5 months after the year end to spend it.
2.5 months, right? Yep. Absolutely. So, and that's cool. Obviously, any way to reduce your taxable income, at the same time, be able to use it for things that you would have used it on with taxed money is better than not, right?
I always suggest that when you have known expenses, like if you go to the chiropractor every month, that's a give me. If you have prescriptions that you get filled every month, you have children that are in childcare, those are steady expenses. Put that into an FSA, and that way you don't lose it. You're going to spend that money on it. Get it into the FSA and take advantage of that.
Find out if your employer offers it, right? Now, there is another version of this, which is an FRA, I believe, right? A reimbursement account. And that's only contributed by the employer, right? And there is no limit on that, by the way. They can reimburse you up to whatever they want to. That can carry over. So it's a little bit different, but the principle's the same. It's income that's not showing up on your tax return that you're getting to use. So Correct. It's another good example of that. Next one being very closely related to this, the health savings account. I know Tammy you really drove down on this. I just had not the best experience with this. I tried to open a health savings account for my brother and I. Now you do not have to be employed, have an employer for this. If you're self-employed, you can set this up. Okay, the limits are a little higher. I think this year for a family, it's like $7,200, somewhere around there, and $3,650 for an individual, something like that. But Same principle though, but you have to have a high deductible health care plan in order to qualify for this. Well, I thought that was going to be easy. And that was anything but easy because this year in PA, we got Penny, right? The PA, marketplace. I'm on the phone with them. They only had a couple of plans that qualified. But tell us about, because now you did it successfully, right?
Well, we're seeing, so for years, the HSA has come out and we've been told as professionals, this is like the win-win of everything. And I've, been educated on it and go back to my clients and I'm like, look at what you can do. The implementation is the difficult part. So that's the hard part. So the key to an HSA is the number one requirement is that you have to have a qualified high deductible health plan. So if you go to Penny, which is the Pennsylvania marketplace, you can do a search for what qualifies for a high deductible
It's mostly
health
bronze
plan.
plans, I'm told, right?
Pretty much, but it was a search function. There were some others, and so if you have a high deductible plan, that is mine and I signed up for it. So I'm implementing it this year. So talk to me in December and see how much of a fan I am with it.
Okay.
I still have to get the SHA account set up. But the idea being that if you have a high deductible plan, you're paying about half of the premium that you would normally pay. But you're going to pay the first $7,000 out of pocket before they cover anything. So if you couple that with an HSA, now self-employed, I'm limited. I can't put full deductible down, but I take that money that I'm saving from not paying the premium and I put it into an HSA and I don't use it. That money stays in the account and rolls over year to year. I now have a medical savings account growing that can be used to pay premiums or any medical expenses. As an employer, if they offer it, they're saving that 50% in premiums. And most family plans, even the basic ones, are $1,200 and up a month per employee. And employers are just like, we can't afford this.
And that, if you're not getting the,
high deductible.
Well, no, I mean, if you're not getting the government.
Well, if
subsidy.
an employer's offering it, there is no deduction from the marketplace.
Right.
Okay.
The employer, right.
So an employer offering it is at $1,200. And if they switch over to a high deductible plan and you have a $6,000 deductible, the employer can contribute tax-free into an HSA account to cover your deductible. And they're going to save more in premiums. So that's what I've sat down with employers going, look at what you're paying in health insurance. If you convert to a high deductible, here's what you're going to save. Even if you put that full deductible for each employee into an HSA, you're still saving money. And the employees who normally go high deductible, we don't want to hear, don't want it. But if they're given a debit card and said every time you have that out-of-pocket expense before you meet your deductible, here's how you pay for it. Nothing's out of pocket. It's not a reimbursement. They're getting that money tax-free. And if they don't use it at the end of the year, it rolls over. They leave the company and walk away. That HSA account goes with them. The employee owns it.
Yeah. No, what I took away from my experience and what you're talking about, and I was telling Rachel this, is if you prepare, you have that information you just talked about in advance. And so my brother and I had already chosen our plans, right? And then tried to do the HSA. Can't do it that way.
No.
You have to coordinate it all and know the numbers in advance, and it can be awesome, right? And then you're talking about possibly a top of the line deduction of another $7,200 for a family, right?
Right.
So you really can't go wrong with an HSA if you plan for it correctly. And I certainly got a lot out of this discussion this week that we've been having about this and this as well. So I totally encourage that as well. So, we talked about breaking down. Let's not go too far. We don't want to keep people too long. We talked about the deductions, how important they are. Just to read out the list real quickly, and we're not going to break them each down, but just so you know, there are a lot more than what we just mentioned. There's costs of adopting a child that can be a deduction. There could be a college education cost that's a deduction. Loss on stocks. We could get deep into that, but your financial advisor and your tax professional should know how to tax harvest, okay? To whether if you are going to cash in on a big gain, say you had Apple or Tesla this year and you want to cash in on that, take whatever losses that you had, cash on in them too, and it'll reduce your capital gain, right?
Right.
So,
and it's good to couple them together, because if you just sell stocks that were all losses, you're capped at only taking $3,000 a year and have to carry the rest of it forward.
yeah, and you're right. There's a limit on how many you can take anyway. So you want to take the bigger gains to be able to take advantage of it, right? In the same year.
Right.
So you can take advantage of more than 3,000 in losses in any one year.
Right.
And then if you're giving money to, or cars or art or investments, household items, or any other types to charity, okay, you can get deductions with that. Daycare and similar costs.
Brian, we did want to elaborate on that charitable deduction or okay. One of the tax strategies that works with the IRAs is if you have a retirement couple and they're taking distributions from their retirement and paying tax on that, and they're then turning around and making a charitable donation to their church, and it's a steady amount, rather than taking the money out of your retirement and then writing the church. And because the standard deduction is now doubled, you're not getting that deduction. So you're paying tax on income that you're handing over to a charity. If you know you're going to do this, have the retirement account make the payment directly to the charity and have the charitable donation come out of the retirement account, and that's pre-tax. You won't pay income tax on it.
Absolutely. We're going to actually hit on that a little bit, something a little different, but absolutely. Now that is a tidbit that might get by a lot of people, especially now since the state of deduction is so high.
Yeah.
Right. So, all right. And then, obviously if you have a family, a home office and whatnot, I know it gets tricky with home offices. Most accountants don't like people doing home offices. Although I'm told because of the pandemic and all that what is going on, it may be the wave of the future. Do you think maybe people need to think about this a little more now?
You would hope so. And I would hope with the 18 bill that came through, miscellaneous deductions were eliminated, which included unreimbursed employee expenses. So if you're a Schedule C with a home office, there's no issue. But if you're an employee working from home, on a federal level, it's basically not taxed or not deductible any longer. However, it still is deductible on the PA and local. So you'll still save 5% depending on what your local tax is. But that is a discussion. That is an entirely whole nother seminar.
Are you having more of those discussions these days?
Oh, daily. And I'm really hoping that because of COVID, more and more people are working from home. Pennsylvania is highly discouraging filing home office deductions.
Really?
Yes, they are.
You have to have a letter from your employer saying they require it.
I don't think that would be a problem these days, right?
No, but they are pushing back. And we had an IRS agent just tell us 2 months ago, it's not worth the trouble. Don't worry about it, which only encourages me to make those extra steps. Because, if the state is saving $20 on every employee that's working from home and not filing, their revenue is driving up by, hundreds of thousands of dollars.
Yeah, no, absolutely.
So the principle of it, but it is the amount of work and the requirements that Pennsylvania has for what benefit you got to weigh. But
like you have to pay use tax on your utilities?
Yes. Exactly.
Yeah, that's true. That's
But
true.
I'm keep hoping that in all of these bills that they're passing, that they'll allow a home office on the federal level to
I'm
be
really
deductible.
hoping the same because you see it so much going that direction. That they start really getting more open-minded to it. Because let's face it, it's a reality now.
It is.
Before, I'm told, in talking to my own accountant and some other accountants, it was a rarity. And that's the reason why it was discouraged. But now it's become so commonplace that you would think the conversation needs to evolve,
Yeah,
and people get that luxury because they deserve it.
right. But keep into consideration that even though that's gone, the best bang for the buck that you can get is to go back to your employer and say, hey, listen, this is no longer deductible and I've got all these expenses on me. The employer can reimburse you for those expenses dollar for dollar. So like the mileage, you get 58.5 cents per mileage. Or used to get it, as an unreimbursed employee expense that did not include commuting. So if you drove for your employer, by the time you got through the deductions, you're not getting a dollar for dollar deduction. Even when it was miscellaneous, it was subject to the 2% floor. So you had to exceed 2% of your income before it became deductible. So it was always advised, if you can get a dollar for dollar reimbursement from your employer, that's tax free.
Have you seen they're open to that?
Have I seen
Are
what?
employers being more open to that these days, you think?
They are, I've done it with my employees this past year, and said, because of all this going on, I'm going to reimburse you for these expenses. Now you have to document it. We have to put it in the employee manual and say, here's the policy, and I need written support from you. So, here's the receipts of what I'm spending, and I'll reimburse you for it. And that does not go on to the W-2, so it's tax free.
Wow, that's another great tidbit. So they're talking about those other popular deductions and strategies that can be put on. I think that you could probably go on with several of them, right? I mean, there's depending on your circumstance, it certainly seems viable to be given that thought, and at least for everybody online with us to be conscious that they exist and to have that conversation.
Yeah, the employer's not going to give it to you if you don't ask.
Absolutely. Another one here just applies really to property 1031 exchanges. My understanding of a 1031 exchange is pretty simple, although I know it can get pretty detailed. But just on a 50,000-foot view, if you have a property and you sell it and you have a capital gain, as long as you purchase another property, I believe it's within 90 or 180 days, they'll allow you to roll that profit into that new property without having to pay the tax on it, make it a non-taxable event, kind of like the same as IRA rollers, right? And that there are rules that apply that certainly, make it kind of strict. It has to be a like-kind property, from what I understand, and sometimes that's difficult to meet their guidelines on. Okay, and you can run the danger of having to pay that tax if you're running out of time, right?
Yeah.
There are certain strategies I've heard of where they have certain rescue investments I'm not going to get into for people who are caught in that situation and haven't found the right property to roll into. But there are strategies that can be put into that. What's your take on this?
Most definitely. If you're going to do a 1031 exchange, you really need to go through a 1031 exchange broker. That's not a suggestion, that's a requirement. So you have 90 days after the sale. Now, it used to be that the 1031 exchange could be used on equipment. So when you're looking at construction companies that have these huge bobcats, and cats, when they would sell them, they would have 90 days to buy another one. You could do it with vehicles. That's all gone. It is only on real property anymore. we're not talking your personal home. So if you have investment properties, but you have to follow to a T. You have so many days, the broker must hold the funds. So it's not like you can sell a rental property and go, oh, I'm going to buy another one and do it by yourself. You have to have a broker.
Right, and there's no new houses down the shore with that and rolling those those funds over. So it's definitely, you know, something to be conscious of that exists if you're in that circumstance. But certainly, like Tammy said, there's a lot of rules when it comes to it, and it's very strictly adhered to.
You actually can do a house down the shore, but if you have to do the 1031, you have to rent it for at least 5 years.
Oh,
And then you can convert it to personal.
how about that? Well, that's a tidbit. Huh.
I've had clients that have done that.
Wow. And they could like sell a duplex and then invest it into a home and roll it into a home down the shore?
And rent it.
And rent it.
They have to rent it for 5 years. It has to be a business property for 5 years.
I see. Okay. All
And
right.
then retire down there.
Well,
Yeah.
that's great.
Rent it for 5 and then retire, and you move down, it becomes personal.
And you can't become your own tenants, right?
I had a client that had a bunch of properties up here. They wanted to move to Florida. They sold each one, did 1031s on them down the shore, and then moved into them one at a time. They became personal residents after a period of time. Okay, they rented them for 5 years. They then made it a personal residence at the end of that 5 years, and then afterwards they sold it.
And took the personal gain exclusion, correct, Mike?
Correct.
Yeah. They would have to live in it for 2
Wow,
years.
that is a good one.
Is it?
Woo! Wow, Mike, that was the jackpot. Talk
Yeah.
about advanced planning.
I mean, you have to recapture the depreciation, but still, it's cheaper than tax.
The gains are tax-free, you know?
Yeah.
Whoo! That is a sweet strategy. Awesome. So, you know, a couple quick ones at the end. It's something that in my practice and some of the advanced strategists that I work with, they call it the little known loan. This is actually very closely related to what you were talking about as far as given directly to a charitable organization. And in this case, though, you would lend it to them. Okay. And, you know, it's not quite that easy, though, because a traditional IRA, you cannot lend funds from. You'd have to convert it to a self-directed IRA. And then you could lend money, not just to actually a charitable organization, but they have qualified entities that could be lent to. And you could actually get into a position where you could have a loan document that has you a fixed rate of return. And then you may be able to get somebody to pay 6% on that loan. And then once that money's paid back, once you retire or when you pass away, this is for someone who doesn't need the assets, obviously, right? Your beneficiaries will still get that money. And you'll get that, whatever your agreement was to interest that you got on that loan. So it's certainly something that could happen. It's definitely more tax efficient than taking distributions from the IRA and then lending it to a charitable organization or anybody for that matter, or donating it because you'll have to pay tax. So it's definitely a strategy that is something that under the right circumstances could be considered. Thoughts on that? Anything of similar nature that you've heard of? Or?
No, I think this one's in your ballpark.
Yeah, that's what I thought you were going to say.
Yeah.
And,
I'm not a huge fan of acquiring debt, but it is something that is available to you.
Right.
So if you have money in an IRA, rather than taking it out as a distribution, using it as a loan can save that tax savings. I've utilized it like that in the past.
Yeah, it's something that's possible. and it can be done, and it could be a win-win given the right situation.
Right.
Here's another one, though. This is one that a lot of people don't really, I'd say most people don't know of. And you could potentially avoid RMDs completely. And this is definitely one of the more advanced. I am not the ultimate expert in that, but in this strategy, but I have dealt with several specialists and the consulting firm that I work with, Elite Resource Team, and we've talked about them in the past, Tammy. Then we mainly work with small business owners, helping them to reposition themselves either for better tax circumstances or mitigating risk or mitigating business expenses or things along those lines. But this is an idea that could potentially work. And I'm just good. This is one of the ones I want to kind of read down a little because it's a little detailed. And folks, anybody would have any questions about this, I'd rather us sit down in public and I'm in private and then really talk about it, maybe with one of these other specialists who really do this for a living. But there's this advanced tax planning strategy as mainly for self-employed individuals with sizable assets in an IRA, could be 401k as well, that they don't really need for the future. So the IRA account holders reach the age 72, which is what we talked about, when you're required to take distributions, no matter if you want to or not, from your retirement accounts and start paying taxes on it, right? So the IRS then requires you to do that, right? And then when you do that, you, depending, not in PA, but you will pay federal taxes on it. So there's a major benefit to if you're some of these people who really want to try to mitigate this tax and willing to go the extra mile, you could possibly go this route. So sometimes, this creates a problem for folks. And I just did a chart where we ran the RMD out to age 100. And if you're in this situation with the RMD, if you have sizable enough retirement accounts, you could be paying $800,000 a year. You could be taking $800,000 a year in distributions, right? And drive your taxes through the roof. It's crazy. But anyway, so in this situation though, so there's a solution where you can alleviate the tax burden at the same time you increase the net worth of the account holder and possibly their heirs. And it utilizes an enhanced IRA planning strategy that implements life insurance into the structure of the plan. Now, how does it do that? Like I said, you have to at least be self-employed. If you were to create a profit sharing plan and roll your assets into this profit sharing plan, okay, you could write provisions into the plan, right, where you could allow the plan to purchase life insurance. Then, when it does this, if you structure the payments correctly, now you just rolled the whole plan into life insurance, okay? It was a rollover, and then that plan purchased it. Now you structure that life insurance in a way where you're not going to have to pay taxes because you do it through loans in the life insurance, which then are paid off when you pass, okay? And since it's life insurance, you pass these assets over to your beneficiaries tax-free. So, and as a result, because it's life insurance now, you don't have to pay an RMD. So this does take quite a few steps and a decent amount of maneuvering. But if you're that averse to the idea, and some people with enough assets could possibly be in a situation where they're open to that, it can be done. So that's another tidbit. One of the last things I want to talk about here is I'm gonna read this a little bit too before I get into elaborate. And I get a little excited when I talk about these things. So if you ensure that you're taking advantage of the right tax planning strategies, it's essential to evaluate the multiple strategies along with each method, the method's inherent risks and rewards. So one such strategy is often utilized, allows a seller of any capital asset to defer the tax for up to 30 years while getting paid a cash amount very close to what the capital gain was. Okay. And this is done by utilizing various installment notes in a specific strategic method. So in essence, what you're doing, and I actually sat through a webinar on this particular strategy. It was there was an advisor and a tax and a CPA who were working together. The CPA had a client who was looking to sell their piece of their business, 50% of it, to their partner. They were retiring. Guy was, retirement age. His partner was a little younger. For $5 million, he was selling this asset, his part of the business. There was $1 million capital gain that he was going to encounter. So, and I'm not going to get into the details, but what was done then was there was a note created that actually turned it into a loan, okay? And there's a trust involved and what have you, but the end result was that this so the money that was going to be paid for the capital gain was then invested in a pretty conservative investment, principal protected. And then what the average of that, and of course, the average return that that vehicle got over a 30-year period, they're estimating that $1 million is going to turn into about $2.5 million. So when that tax becomes due 30 years later, you're paying it at the tax rate of 30 years prior, and you walk away, or most likely your heirs walk away with the gain on them, which in that case was $1.5 million. So it's a pretty elaborate advanced tax planning strategy, but it absolutely can be done. And I've actually sat through and heard some intimate details to it. It's pretty exciting, but it depends then on your circumstance and what you have a capital gain on as well. I know the one thing that you can't do it with is the sale of stocks, but sale of a property, a business, these types of things can absolutely be done. So I don't know about you, Tammy. I know with all the mishaps of this and the craziness that we have with the link, we obviously went way too long. But if there's anybody who has any questions and want to put it out, I think we lost, probably half the folks at this point. But we'd be happy to take on some questions if there are any questions in the. Oh, you see the chat. You see the chat, right? At this point, I don't really know if we have the time for it anyway. What would probably be better is if you reached out to me or Tammy personally. And if you want to, Tammy, do you want to put your information into the chat?
Yeah, I'm going to put my email into the chat. So if anyone has any questions that they want to ask me, I'd be happy to take a couple minutes to answer them for them.
Right, absolutely. And, my personal information, we are going to put into the chat as well. Once we figure out how to get to it, unfortunately. Tammy, you have my email and my phone number as well. My phone number is 215-804-9708, my business number. And my email address is bdougherty@plcfs.com. So if you want to put them in for folks, that would be great. And we'd love to hear from you personally, talk about any of these strategies, anything really that you want to talk to, if this spun any kind of thought-provoking, anything of any thought-provoking nature related to anything like this, or questions, we'd be happy to air it. So I think right now, given all that's occurred, we're going to end it for tonight. I want to thank everybody for joining us and putting up with the chaos in the beginning. And I want to thank our co-host, Tamatha Policheti and Mike Davis. You guys were awesome and really put out some amazing information. And I can't thank you enough for coming on. So everybody have a great night.
Take care. I hope everyone
Take care.
is able to walk away from this with a few nuts and bolts and got something out of it. But Brian, thank you for having us. And I hope everyone has a good night.
Absolutely. See you guys.